All right, guys. So we are here today. We got the FOMC meeting going live. Yeah, starting the stream a little bit early. I mean, I'm sitting here watching. I might as well start the stream up. There's Apple doing really well. You can see we're up about 335s on the day. The FOMC decision is going to be at 2 p.m. We'll get a timer going. $2.30. All right. What's up, Blaze? What's up, Zach? Hey, thanks for becoming a member, man. Yeah, so what I made this other $150 on, I got back to my computer, and when I was looking at this, the first thing I saw was like, hey, we're at the bottom of this range. We got this range right here. A lot of the time ahead of big economic reports and on big economy days, we're flat, we're choppy, we're going to bounce at the bottom of the range. And so I ended up buying this dip right here. Pretty simple, bottom range dip buy. And it worked really well. You can see we're now up $335 on the day in our funded account here. This is a 50K funded account. You can see my gains right here. Realized P&L right there. So we're doing pretty good. Strategy, we're still kind of testing this strategy. Honestly, I've been talking about it a lot the last month and a half. It works really, really well. I would say it definitely works over 50% of the time. And that's all you really need, honestly. So the more I get comfortable with this, the more I'm going to start building up a cushion. Not just in my funded account, but in my actual accounts as well. The more I get comfortable with this, the more I'm going to start building up a cushion, take some large swings eventually, hopefully, is the goal. Yeah, we'll do a poll for sure. Yeah, so let's go ahead and do it. I don't think we're going to pause today. So I don't even think it's necessary to do a poll. What I'm going to ask is, will Powell's tone during the press conference be hawkish or dovish? Or will Powell have a hawkish tone? Hawkish or dovish tone during today's FOMC press conference? Hawkish, dovish, neutral. I don't know. See results. That's what we're gonna do. All right. Let me know what you guys think. Whoa, why does it say you're spamming? You only said good afternoon. Sorry, NDA. I'm not sure why. Oh, you posted the same emoji 4 times. My bad, bro. Yeah, Nightbot's out of control. I'll have to judge those restrictions. Maybe loosen them up a little bit. Papa Powell probably practicing hawk faces in the mirror. Maybe. Again, I don't know. We got optimistic inflation data today, so. Two rate cuts this year. Rate cuts mean Marcus Palm getting his hawk and dove faces on the pre-prep. Yeah. All right, we're here. Again, I decided to start streaming a little bit early today just because I can. Yeah, again, expected pause is what almost certainly is going to happen. We'll put the FOMC stuff up a little bit later, but we're almost certainly going to pause rates. I don't know if you should buy or sell. No idea. So 35% dovish, 30% hawkish, neutral. Honestly, I was just thinking about how I got this number right again. I have to go back and check how many times I've gotten the CPI number right. I think I got the last one wrong, but man, it's just weird I got it exactly right. Very strange. Again, part of me is like, hey, you should start betting on these CPI reports. Hopefully it gives the stream some credibility. I do use balance in my analysis of CPI reports, but I feel like it's luck. Like, I'm just kind of thinking in my head, okay, well, you know, this is what happened the last CPI report. The Fed tries to stay balanced. It's an election year, so I'm going to go with a slight improvement to inflation because inflation has gotten rough. And so I think the Fed's been working hard. They're slowing QT down. We're going to see some more damage to inflation. Slowing QT is the opposite of combating inflation, though, just to clarify. But I don't know. Should I start betting on those CPI reports? Because, again, I guess this one exactly right. I've gotten, again, out of the last, 7 CPI reports, last 7 months, I've gotten it exactly right. I think at least 4 or 5 times. So I wonder what the edge is there. To me, it feels like I'm guessing, but I'm doing something right when I'm predicting those. I'd like to see us hold the line. This is great. Hope Fed doesn't change a thing. I agree. I think we should keep it right the same right now. As someone who bets on them sometimes, probably don't. Yeah. Hey man, can you please explain how the Fed rate hike or rate decision will affect the market in simple words? Thank you. So every rate decision, regardless of what the Federal Reserve tries to do, you know, the Fed's job is to keep a balanced economy. And so if the Fed determines that inflation is a risk, they will raise interest rates higher, you know, through a number of different ways. They can reduce the supply of money through quantitative tightening and liquidity in bonds, and that will cause banks to keep interest rates high. They can increase the supply of money, you know, money printing by doing what's called quantitative easing, which basically means they create virtual money and then buy bonds and other financial assets with it. And this injects liquidity into the bond market and allows banks to lower interest rates. And so depending on what the market or what the Federal Reserve thinks is a big risk is going to influence what they choose to do. You know, they'll limit the supply of money if inflation's a problem, like we've seen over the last few years. They will inject liquidity if depression and recession risks are there, if the labor market is struggling. And those are two sides of the, you know, economic Fed spectrum, so to speak. Regardless of what they choose to do, though, regardless of what the Federal Reserve will choose in terms of their rate decision, a couple things are, you know, incredibly important to understand about every major FOMC meeting and decision, I should say. The first one is that we're almost always going to go with what the analysts' expectations are. And so if we look at like the main tool that people look at is the CME Watch tool, the Fed Watch tool. The CME Fed Watch tool, you could Google it and this page will come up. It'll show you what's expected. And so today, when we're looking at this specifically here, we see 99.9% of people are expecting a pause in rates. So the Federal Reserve, essentially, we've raised rates aggressively over the last few years. For the last year or so, we've been pausing rates at where they are now, which is called a rate pause. We're not increasing short-term rates. We're not lowering short-term rates. We're pausing short-term rates where they are, which is at a fairly high level, you know. Now, we do have a small, tiny percent chance, 0.1% chance of a cut today, but it's just not super likely. You know, if we do cut today, it's going to shock the market. Anything could happen. And so it's, you know, but in terms of probabilities, it's super skewed towards pausing, you know, which is a neutral report. It's what's expected. It's if we're looking at it in terms of like a metric, it's the expected metric. It's what most people are expecting today. And so in that regard, it's kind of a neutral, you know, it's a neutral thing. So if we come in at a pause, that's what everybody expects. That's not a shock. That's not going to cause, you know, if we come in at a rate cut, we can argue the reaction to it. I don't know. You know, it definitely would be a more dovish sign, a more positive sign for the economy, but a less positive sign for inflation. And so it depends on what the market fears, and that fluctuates. The more important thing, so essentially, if we come in at a pause, which is very likely, that's a neutral reading, we don't really know how the market's going to react. Sometimes it reacts good, sometimes it reacts bad. We don't really know. The more important thing to watch for this Fed meeting is going to be the press conference with Jerome Powell. When Powell gets on the podium to speak, what he says regarding, think of it kind of like earnings guidance, right? But instead of a stock, this is the economy, right? So when you listen to Powell speak, you have to listen to it as as foresight into what we may see later on this year, like what we might see in terms of Federal Reserve decisions, like what the Fed's going to do for the remainder of the year, as well as what the economy looks like. What the economy looks like, where the jobs market is, whether we have recession, depression, inflation risks, how many rate cuts we might do this year, if any, and when that might be, so forth and so on, right? So those are all things you want to pay attention to. What's the current state of QT, the quantitative tightening? Basically, what's the current state of limiting the liquidity of bond markets to try to discourage the economy, to discourage spending, because currently the Fed, at least the Fed, has been in this quantitative tightening cycle where they're trying to limit the liquidity and the supply right now so that they can kind of push spending down a little bit to combat inflation. They do this when inflation is a problem. So you can listen to what they're going to do. Last FOMC meeting, they talked about slowing QT down, which is a more dovish thing. If you want interest rates to drop, that's a more optimistic sign if they do slow QT down, which again is limiting the supply of money to where it keeps interest rates high, pushes spending down. Can they increase rates? I mean, they could. It's just not very likely at all, but they certainly could. It's just not probable. The other central banks did a hawkish cut. Not sure which way the markets will take it. Yeah, I mean, I don't know. I think we're going to be a dovish pause, is what I think. I think in my argument for that is very simple. I think that Powell's probably already getting pressure for a cut. It's an election year. I'm sure he's getting pressure from, different groups to cut rates and bring interest rates down to stimulate the economy during the election year. I'm sure that's something that's happening right now. I don't think he's going to do it. And so to compensate for that, I think during the press conference, he's going to have a dovish tone to kind of compensate for. Like, hey, I'm not going to cut rates for you guys, but, I am going to speak dovishly about the economy, optimistically, dovishly about the economy. And in that regard, maybe we get increases. At the same time, market's up a lot. In terms of just base extension, I'm not sure. But that's my theory today. I might be wrong. I think that makes sense. If you think about it, I think that makes sense in terms of, like, if you're Powell, you got to put yourself in Powell's shoes. What would he do? He doesn't want to cut rates too early. Hopefully he doesn't, at least. If he does, I think it's a bad decision. But he also wants to kind of help out the people, like, he wants to help out whoever wants him to cut rates, I think. I think that makes logical sense, that he's not going to cut rates like they want, but to compensate for it, he's going to be a little bit more dovish than usual. I think that's my guess. We also saw better inflation data today. We saw lower inflation data, so that's a good sign. So yeah, I think he's going to be a little bit more dovish, but who knows? He could be anyway. He could be hawkish. He could be really hawkish. I'm not sure. I'm going to give you guys, if you want to see the probabilities for each individual Fed meeting, go to this link. It'll be super interesting to see Max Forex. This will be my first cut cycle while trading personally, and I hear mixed opinions. Far more experienced traders. Yeah, I mean, again, like CPI, man. You got some people who, for whatever reason, maybe they understand, like, if they title their videos, hey, the market's gonna crash, then they get more views. But you got some people that just every FOMC meeting, they're telling everybody the market's gonna crash. I've been through enough of them to where, you know, oh, I didn't set a timer, my bad. Here, I got you guys, hold on. I've been through enough of them to where I'm not saying we don't crash today. I'm used to, we might get volatility, but a crash is a different story. All right, so we got, all right, so look at the market bounce back up again. Again, we're probably going to get choppy behavior leading into this. All right, so here is the timer. We got about 57 and a half minutes here. We'll put this back up afterwards. Let me put the SPY up. I'll probably put the SPY gold. Apple's been ripping up today too. Apple gold, maybe the Dixie. Dollar index is down. SPY is up. Gold is up. Yeah, as for that AD, he said, hey man, how's it going? I wanted to ask a quick question about the NASDAQ. As we can see, there's between 2 and 3, maybe 7 contracts on the bid and ask at all times. So let's say I want to buy 100 contracts. Will there be 100 to sell? I'm talking about a very quick entry, not a buy. That takes 2 to 3 seconds to fill. I mean, that's super, it's hard for me to answer that. Yeah, I mean, platforms are going to be different. It depends on your platform. Usually they're doing it in terms of like markets. There's like an exchange that has all these orders. And so each order that you see, what are you talking about? Are you talking about what are you looking at? Time and sales or level 2 is one thing, right? If you're looking at time and sales, that's filled orders. If you're looking at level 2, that's just orders, but they could be a bunch of different contracts per order, right? So it's, I would ask the platform. Well, I heard they refreshed Rhythmic accounts. You know, they updated their promotion. It's now 71% off any size evaluation. All right. The liquidity's fine. It's super deep AD. Like you got to understand what the QQQ tracks, what the QQQ, which is a very popular ETF, right? Like, let me look at this. So the average daily volume on the Q is 32 million. You know, roughly 32. It's roughly 40 million is the average volume for the QQQ. So daily volume, and so yeah, I mean, the liquidity's fine. In terms of the Nasdaq, it's what the QQQ tracks is the Nasdaq futures contract, the Nasdaq 100. And I would argue the NASDAQ is more heavily traded than the S&P E-mini futures contract, But I might be wrong. I don't think I am. I think, from my experience, the NASDAQ is the more heavily traded because it's the more volatile one, right? And it typically has more volume, I think, as well. So, but again, I'm not 100% sure. Anyone trading the Dow? I trade the Dow sometimes. Any speech tomorrow? No, tomorrow is PPI inflation data. So tomorrow we got the other side of CPI. Bro, I want a new house. I mean, I'm about to buy a rental property myself. I was looking at the $200,000. Like, I was going to get, like, what do you guys think? For my rental property investors, let me ask AI. Like, what's the safer long-term investment? I would assume, like, we went and looked at a couple houses that were like 210K. Most of them were like 2 and 3 bedroom houses. But most of the ones we look at, I just wasn't impressed by them. And so, I talked to my wife, and like, we're going to end up just increasing our budget a little bit to like 250, I would say. But the other part of me says, well, I could buy a couple different cheap ones. Like, I could buy two $200,000 houses, and I'm sure that would be better diversified. I could also buy multifamily, is what I was thinking about as well. I could also buy multifamily, so. Yeah, duplexes. No, I think ES is around 2 mil a day, maybe a bit more than NASDAQ. It's roughly 600,000 to 700,000 a day. But if you look at the level 2, the book of the E-mini is much more crowded, so to speak. Well, yeah, I mean, if you're correct about the volume, then I guess the E-mini is more traded. I don't know, though. Like, so in terms of liquidity, right, here's the NASDAQ, right? So here's the NASDAQ liquidity. So here's the NASDAQ liquidity. When I pull up the E-mini, if I do the same thing, doesn't this look lesser volume? Like, it looks smaller range, lower volume. Again, it's just, it could be based off of what these track. It's the NASDAQ here, NDX, the NASDAQ 100 index right here. So it could have to do with the index that they all track, but I don't know. Again, I would ask somebody else. I'm probably not the right guy to answer that. Yeah, long-term rentals is what we're looking at. Well, yeah, we're probably not going to cut rates today. I wouldn't bet on that. I wouldn't trade until after it and just kind of react to the trends we get. Houses in Houston are overinflated with $125,000 houses selling for $250 in the last 2 years. Yeah. Yeah. Well, I mean, if you go to big cities, like super upper scale big cities like Miami, like New York, like Los Angeles, you're going to have, it's going to be more expensive homes wise. Like $1 million house in Texas, basically anywhere in Texas, $1 million house, except for maybe Austin. Austin, Texas is a little bit up there. But outside of Austin, you spend $1 million on a house in Texas, you're either getting a straight up mansion or a mini mansion with a huge like property. You buy $1 million home in Cali or New York, you're going to get like a tiny little house. So I think the thing to understand is that real estate appreciates at an average of about 5%. And if I have cash, I have, Yeah. Yeah, you get a little bitty house. Is PPI data important? It's pretty important. I mean, typically PPI streams, we get 10, 15,000 people, or 10 or 15,000 views. We probably get like 3 or 4,000 watchers, 2 to 3, 4,000 watchers. It varies. But it's a watch. It's the other side of the CPI report that we had this morning. So this morning we had CPI inflation. The other side of that is PPI inflation. CPI is consumer inflation. PPI is like business inflation. John, I think he's going to be dovish. Yeah, again, my argument is this for the Fed meeting. Again, I might be wrong. I'm just kind of throwing this out there. I just kind of theorized on it a little bit. Again, this is my theory. I might be wrong. Okay. My theory is that Powell right now is getting pressure to cut rates, right? Because Powell is getting pressure to cut rates, I don't think he's going to cut rates. I think it's too early. But I think because of that pressure to cut rates from whomever, right? It could be, different groups. It's an election year. They want a thriving economy. They want him to cut rates. Because of that pressure to cut rates, and because he's not actually going to cut rates, to compensate for not doing what they want, I think he's going to be much more dovish in his press conference today. I might be wrong. I certainly could be wrong. That's my guess. Again, let me know if you agree or not. Yeah, we're probably going to pause rates. I don't think we're going to cut, but because of that, I think he's going to be dovish to compensate for it. $640 square foot house on a lot that's like 2,000 square feet is $1 million in South Compton. Yeah, but that actually might be a good investment, Nvidia's starting to creep back up too. I'm still green. Home Depot treating me really well today. Intel gave some of it back, but that's all right. We took some profit. Netflix still good. Rates are already going down. Yeah, I mean, it's probably because they slowed QT down. And we're not going to hear about it until after the fact. So they might have, Yeah, we're not going to cut rates today, almost certainly. I mean, maybe we do. Anything could happen. I might be wrong. I just don't think they're going to. The speech is at 2:30. The rate decision is at 2 p.m. So you can see a timer up here. Yeah, I mean, I don't know. I think it would be a bad move to cut. I think we need to see inflation at like 2.83 at least before we start cutting. I don't think 3.3% is good enough. I think we need it under 3. 2% is the target. I just think it's too early to cut. I think if we cut now, the risk of inflation spiking and there really being problems gets up there, Is it a good time? I want to ask ChatGPT about the housing thing as well. I hope they don't. Yeah, I agree. No cutting too early. Yeah, I think we keep it the same. I think we pause rates. We keep it very much the same. All right, guys. Somebody's asking, should I buy bonds? I don't know. If you think rates are going to start going down, which I think a lot of people are saying they already kind of are. If you think rates are going to go down, it might be, bond prices could start going up. There's an inverse correlation between rates and bond prices, and there's a positive correlation between rates and yields, right? So interest rates and yields typically follow each other. So if rates go up, yields go up, prices go down for bonds, So if you think interest rates are going to start dropping, you could buy bonds, but yeah. Yeah, I really don't think cuts are going to be announced. Maybe. I mean, they might. I don't know. It's an election year. They're getting, like I said, I think my theory is that they're getting pressure to cut, but that Powell is not going to cut. And to compensate for him not really doing what they want him to do yet, he is going to have a dovish tone in the press conference, is my guess. Is there a historical graph that shows inflation month over month? Yes. Here. This is inflation. Again, I can tell the story of the economy over the last 20 years. So the mortgage disaster happened. And so, think 2008, the mortgage disaster. If you've ever seen The Big Short, the movie The Big Short, the mortgage disaster happened. During this period of time, the Fed stepped in and they did quantitative easing. They printed money. They injected liquidity into the bond market, and this allowed banks to lower interest rates to consumers. And so, you can see they started doing that here. And one of the consequences of doing so was that inflation spiked back up. We hit the little mini recession depression from 2008. So we kind of went into that. So you can kind of see inflation drop along with the kind of little mini recession that happened then. And then, the Fed did QE, pushed inflation back up a little bit, which is the consequence of money printing in QE. We did a very similar thing. In between then, we kind of just stayed up and down CPI inflation terms, anywhere between, 0% and 5%. The same thing happened in 2020. The Fed stepped into 2020. They did quantitative easing again. They cut rates. They brought rates down here. You can see where they bring rates down, right? If you pull up, let me see if I can pull this up. Right, so if you put up a federal funds rate graph, let me see if it lets me do a long-term graph. Yeah, so here's a long-term Fed funds graph. Super long. That's a little bit too long-term. I just want to see from 1999. Yeah, there we go. Okay, so here's the Fed funds, right? And so again, you can kind of see they did QE. After the dot-com crash, they did it. After 2008's mortgage disaster, they did QE and they brought rates down and they kept them down. The consequence was inflation spikes. And so when you look at the inflation graph, they did the same thing back here in 2020. 2020, the pandemic happened. They stepped in, they brought rates down. Again, they did quantitative easing again. They printed money, bought up bonds and financial assets, and this injected liquidity into bond market and banking and allowed banks to lower interest rates to consumers. And so you can kind of see the consequence following that QE in 2020 was inflation spiking up. And then the Fed stepped in and started doing QT, which is taking liquidity away from those markets and causing banks to put interest rates higher. And they do this to combat inflation. And so you can kind of see inflation come back down a little bit. That's basically monetary policy for the last 20 years. And yeah. Right, exactly. That's what I think. I think Powell will not cut rates. I'm sure he's getting pressure to cut, but I think and again, this is just a guess, I might be wrong. I think he's going to pause rates, but when it comes time for the press conference, he's going to have a dovish tone to compensate for not actually cutting rates, but I think he's going to stay dovish to kind of pander to them a little bit, I guess is the easiest way to put it. I think that makes sense. And so, again, if you think dovish equals bullishness, I mean, maybe the market goes up again. I don't know, though, dude. The market's already up a lot. And he could very well be hawkish. I'm not sure. We'll see. FOMC bullish or bearish? What's your thoughts? Oof, I don't know. Again, in theory, I think Powell will not cut. I think he's going to pause rates, and then I think he's going to have a dovish stance that might make the market go up. I might be wrong, though. I could be wrong. And then remember, tomorrow we have inflation data. The thing is, again, the market's up way too much. Right, exactly. Like I don't think we're going to cut. It's super outside the possibility percentages. I think it's like 0.5% expect a rate cut today. So it's just not super probable. It's almost certain to be a pause. But again, I think he's going to try to pad it a little bit because he's getting pressure to cut by having a hawkish tone, and maybe that makes the market go up short term. I don't know. Tomorrow we have PPI inflation, and I think that's important to watch. So here's the NASDAQ. Here's the SPY. We'll put the SPY up. That's probably more recognized. SPY, what's the high? What's the lifetime highs, man? The SPY is breaking lifetime highs all day today, bro. That's the only reason I think we might not have that's the only reason I think we could also not have a positive reaction. I think, I try to put myself in Powell's shoes. And so if I'm in Powell's shoes, and politics is about making different groups happy, right? That's all it is. If I'm in Powell's shoes and I'm getting pressure by one side to cut rates, then, and I know I can't cut rates, or it's way too early to cut rates, what do I do, right? What I do is I don't cut rates, but I also say optimistic things about the economy to give people some, like I said, optimism about it, and maybe that makes markets go up. I think that makes that makes reasonable sense. But again, he could just go the other way and say, no rate cuts. We're going to be super hawkish and talk about inflation problems. And, not even mention we're going to cut rates this year. That's possible as well. And if he does that, then, markets are probably going to tank. I'm not sure. Again, time will tell. We'll have to wait and see. We're going to stream the whole thing live. I just paid $20 for a Happy Meal at McDonald's. How could anyone not be dovish? Yeah, I mean, TJ, I don't think you understand the correlation, brother. I see people do this all the time. I don't know if you understand the correlation, bro. Again, and I'm going to explain why, TJ. TJ said, I just paid $20 for a Happy Meal. How could you not be dovish? Because dovish means worse inflation, sir. Dovish Fed means bringing interest rates down. The consequence of bringing interest rates down is people spend more. Inflation gets worse. And so, yeah, if you're mad about an expensive Happy Meal, you don't want them to cut rates, bro. You want them to be hawkish. You want them to keep interest rates high, discourage spending, make the market go down, or make the economy drop a little bit and combat inflation. That's what you want. Yeah, I haven't eaten McDonald's in like a straight up year plus, man. It's been a while. Yeah, maybe 20 Canadian dollars. Again, guys, I see a lot of people that don't understand the correlation here. Okay, listen. If you are mad about high prices, guys, if you are mad about prices being too high, the answer to higher prices is not a rate cut. That is not the answer. That will make inflation worse. Okay? I'll show you the proof here. All right? It's very simple. Makes sense. In 2020, after the pandemic, the Fed brought interest rates down to almost zero. They cut rates. They brought interest rates down very, very low. Very, very low. Okay? What was the consequence of that decision of bringing interest rates down, of cutting rates as well as doing QE? What was the consequence? Inflation spiked to almost 9% following 2020 in the low interest rate state of it. So again, that's what people are really unhappy about, is because rates were too low after 2020. Stimulus checks definitely didn't help either, but that's why prices spiked. You can see it here. Then when the Fed steps in and does the opposite and starts raising rates, that's when we see inflation start to come down. So yeah. Again, If you think inflation is bad, you do not want them to cut rates. That is the opposite of what you want. You know, if the argument for rate cuts is like, hey, I'm having a hard time finding a job, GDP's dropping too quickly, that's an argument for rate cuts. Yeah. Results from history isn't no guarantee for the future. I mean, that's true. Mark Twain famously said, history doesn't repeat itself, but it definitely rhymes. So yeah, I mean, yeah, it does. That's why the Fed's doing this. The Fed is raising rates to combat inflation. That's why they're doing it. The reason they cut rates is to combat recessions and depression risks that we had in 2020 as well as 2008. That's what happens. What does hawkish and dovish mean in this poll? Hawkish means a contractionary monetary policy in which the Federal Reserve is trying to keep interest rates high to combat inflation. Dovish is a expanding of the monetary policy and wanting to expand the economy, wanting economic growth in terms of more spending to combat recession and depression risks. Too little people working. Too little spending is going on. The Fed is going to be dovish to try to stimulate that spending. They're going to try to bring interest rates down to combat the too little spending, too little jobs, whatever recession, depression risks are there. They're going to be dovish, and they're going to bring interest rates down to stimulate spending, because when more people spend, the economy grows, right? And we're no longer at risk for recession or depression if enough of it happens. People get hired, more payrolls go up, all that different stuff. If we're on the other side of that spectrum, in which the labor market is too strong to a point in which inflation has gotten out of control. If inflation's the priority, the Fed usually is going to be hawkish, meaning they're trying to push down the economy to discourage spending, because the less people that spend, businesses in turn lower prices. Because if you sell bubble gum and you put all this bubble gum out, nobody's buying it. It might be too expensive. You're going to drop prices, right? That's kind of it in a nutshell. But yeah, point is, If inflation bad, keep interest rates high. If recession bad, bring rates down. Lower interest rates. That's essentially what it is. Buy the rumor, sell the news. Yeah, baby. All right, guys, we got 30 minutes. We got over 1,000 people live. Very well said. Yeah, I mean, once you start to understand that truth, right? You start to understand. You might hear this like. There's a lot of jargon that floats around in economics and markets. All right. Let me use AI to answer this. Yeah, there's a lot of jargon that floats around here, guys. It's important to understand like what it all means. There's a couple lines in The Big Short that explain this. Truth is like poetry, and most people effing hate poetry. That's one of my favorite lines in The Big Short. Truth is like poetry, and most people effing hate poetry. All right. Yeah, guys. So SPY dipping down a little bit to the 200 EMA. Yeah. Yeah, so again, here's the line from The Big Short. I was trying to find it. It goes, quote, "They use fancy terms to make you think only they can do what they do, or even better, for you to just leave them the F alone to begin with," right? Talking about banking. Very true, very true. But once you start to understand what the Federal Reserve is doing, they're influencing rates. They control short-term rates. This trickles into long-term rates eventually. So they're influencing short-term rates. Eventually, it's going to trickle into auto loans or mortgages or lending in general around the country, right? Lenders. And so essentially what they're doing when they raise or lower rates is they're raising or lowering all different types of interest rates throughout the country eventually. And so because, again, the logic is that when people are paying more money in interest, they have less money to spend on other things, and so it contributes to less spending. If inflation's a problem, we need less spending, and that's one of the ways they get it. The other side of that is if we want to contribute to more spending, you can bring interest rates down, right? By bringing interest rates down, if the public or businesses and banks are paying less money in interest, then they're going to spend more money on other stuff. If you're paying 2.5% in a mortgage instead of 7 or 8% like we are now, you're going to have more money to spend on other stuff. You're going to buy more stuff. Businesses are going to grow. It's going to grow the economy in that way. But that's not always healthy because, again, anything could happen and inflation can get worse. Man, look at the market turn a little bit. Still up a lot. Yeah, I'm trying to catch back up here. This has to do with bonds, I think. The Fed meeting got leaked. See, every major decision, people always say there's a leak. It very rarely is. I can't even fake type as fast as my man types. I type 100 words per minute. Right before you guys right before I streamed today, my wife came in here and I was typing up the bottom thing that you're reading right now. She thought I was just kind of clicking buttons. But no, I type 100 words per minute. Top 3 greatest typers of all time ever in the world right now. Unfortunately, it's a completely useless skill that does nothing, especially in the age of AI. Chart is in the middle is the S&P 500 ETF. It's called the SPY. I hope they raise interest rates. They're not. They're going to keep things neutral. They should keep things neutral. The Fed minutes came out at 1:30. No, it didn't. The Fed minutes has been out for 3 weeks now. Again, the Fed minutes report. Okay. Every 6 weeks, the Fed makes their rate decision and accompanying press conference. That's what's today, is the rate decision at 2 p.m. in about 25 minutes and the accompanying press conference that we get from it. That's every single 6-week period. We're going to get that. We're going to get a press conference and a rate decision. Weeks after that, specifically 3 weeks, right in the middle of the period between each Fed meeting, we get what's called the minutes report, which is a detailed 12-page document detailing why the Fed chose to make the decision that they did, what the economy looked like at that moment in time. It's basically a detailed report reaction to the previous FOMC meeting. And so the last minute report was from the meeting in May. The May meeting, we had the minutes report a couple weeks ago. Look, I could show you where I streamed this report. Look, here's my last FOMC minutes report. Gotta find it. Yeah, so here's my FOMC minutes report that we streamed right here. Yeah, that's 2 weeks ago. So, yeah. All right, guys. Hey, we got 25 minutes. 25 minutes. Catch back up on chat. prove it, put one of those typing words per minute. I've already done it. I don't feel like doing another typing test, to be honest. It takes up too much time. I end up having to, like, maybe after the report drops. Now you put off the term and have a keg party. Yeah, so again, Europe cut rates, the ECB cut rates, Canada cut rates, but yeah, it doesn't mean the U.S. is going to do it. In fact, we can see the expectations for the rates. You know, again, we're almost certainly not going to cut rates. It's just not something that is going to happen, guys. I mean, listen, I could be wrong, and you better believe if I'm wrong here, I'm never going to hear the end of it. But it's just not, it's not probable. All right? It's just not probable. Again, there's where we're currently at, which is a pause. We're at 525 to 550 basis points. 99.9. That's the biggest disparity between 0.1%, 99.9% chance. You know, it's just, I mean, it's nothing's ever definitive in terms of these decisions. It's just not very likely at all, of course, with 0.1% chance. Again, what it will do, though, is it will cause, if we do cut rates, it's going to shock me and everybody else. And so we could try to guess what the reaction of that shocking outcome would be, which I don't know if we'd get a good or bad reaction. That's a good question. If we do cut rates, do you think that's what the market wants? Do you think we see a positive equity reaction in markets or a negative equity reaction? It's difficult to figure out. I think it would probably be positive, although I think there were some people like me that would also not be upset, but I would be shocked and I would disagree. You know, I mean, the Fed has data that I don't, so maybe they know something that I don't. And again, keeping interest rates high for too long, right? It's not something that, it's not like there's no consequence to this, right? By keeping interest rates high for too long, the consequence is recession, depression risks. If you keep interest rates too high for too long, businesses struggle, banks struggle, you know, businesses in general. It pushes the economy down. And if the economy gets pushed down too much, unemployment spikes, you know, GDP slows, recession and depression risks are there. And that's not what we want either. And so I always, like I always say, it's kind of like picking up pennies in front of a train track, where you can do it for a certain amount of time. You don't want to do it for too long. Yeah, I mean, I agree. I think a cut could indicate a slowing economy and more fear by the Fed in terms of economic risks. And so we could have negative market reactions and people selling in order to kind of get in front of the train of recession risks that's there. And so, yeah, that's possible. Someone who can't see the underlying problem of low interest rates. Yeah, I mean, the problem is clear. It's inflation, you know. You get pressure from a lot of different sides. Real estate, you know, mortgages, banking. They want low rates because their business thrives with low rates. But low rates are not something that, if there were no consequence to keeping low rates, we'd always have them, you know. Unfortunately, you know, doing too much of anything is bad, and keeping rates low for too long is bad. It causes inflation. So it's a balancing act. Would you ever do a podcast? I mean, this is kind of a podcast now. To be honest, it's time related. You know, like I start my stream, I get up at 5 a.m. my time, like Texas time. I'm up at 5 a.m. I have a good life balance now. Like I can work in the morning, finish work by noon, and hang out with my family, watch my kids get older, you know, spend time with them. Again, we've been watching the Star Wars movies. We just finished the prequels. My wife watched almost two of the episode 1 and episode 2, completely oblivious to the fact that Anakin was Darth Vader. Right, so she's watching it like, oh, Annie's a great kid. You know, he's gonna do the right thing. And then episode 2, you know, he gets his mom and kind of murks all the whatever they were, and has that big dun 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 dun. And she was like, she freaked out. It was hilarious. My daughter and I have seen all of them, so we're sitting there like giggling like little girls when she's not looking, you know. It was funny. It was fun. I enjoyed it. She liked it. She kind of got into it too. You just spoiled the movies for me? You'll be alright. If you haven't seen them yet, I mean, you'll be alright. Alright, Nvidia at 126. You guys ready? Right, 100%. I agree, TJ. Like, it is Q's fault. I'm just going to call him Q. Qui-Gon Jinn, or whatever his name was. It is his fault, bro. Like, listen, so you're going to tell me you got this super powerful Jedi guy, right? But with his mom, you're just kind of like, you know, you're a freaking Jedi, bro. You got an unlimited bankroll here. You got a big wallet, okay? You know, if I'm freaking Annie, I'm taking Qui-Gon Jinn out first, you know? Like, you take me away from my mom? You don't even free her? It's a jerk move, you know? Anyways, Nvidia's starting to spike. It's at 126s. How's the Dow falling? They're all up a lot. You know, I haven't even looked at the Dow. What's the Dow symbol? It's DJI? Yeah. Here's the Dow. I don't know. The Dow's still technically green on the day. It just kind of gave a lot of it back. You know, we had inflation come in better than expected. Yeah, so inflation came out better than expected. Might be close to the top. We buy gold. Where's gold at? Gold. Oracle did really well. Most of the market's been following Apple here. There's the Dow. The Dow's still technically green. Apple, very strong day. Very strong day. It's really funny because, again, weeks ago, after the Department of Justice lawsuit potential was announced for Apple, people were saying Apple was done. It wasn't it. People were saying Apple wasn't in the Magnificent Seven anymore. You know, Apple's one of the largest companies in the world, right? Everybody's saying, "Oh, Apple's done. Apple's done." Like, people are so short-sighted sometimes with markets. You know, again, I told them the same thing. Apple's one of the strongest companies in the world. It's one of my favorite stocks to invest in. Yeah. With that said, now Apple breaking lifetime highs today. You know, got up to 218s. Look at this chart. You know, very strong, very strong. SPY coming back down, still green on the day though. You know, here was the inflation data, just to show you the scale of what the market has done today. Inflation data showed up right here, and we have flown up. So we're still very green, very up on the day. I'm truly new in economics. What does it mean to Powell have a hawkish tone? It means that Powell wants to keep interest rates high because inflation is risk. You know, there's two sides. You can't be both at the same time. Unless, you know, I mean, stagflation, but different story. You can either want interest rates to go down, which will stimulate the economy, but also potentially cause inflation, which is dovish, right? Wanting interest rates to go down, expanding the economy, you know, bringing interest rates down to expand the economy is a dovish sign, right? It's a dovish Fed. A Fed that wants to expand the economy by bringing interest rates to low levels so that people spend more is a dovish Fed. A hawkish Fed is when they want to keep interest rates high or raise interest rates or keep them high, which is kind of what we're in now. They do this whenever inflation is a problem, whenever they want to push the economy down to combat inflation, because the less people that spend, the lower prices get, because supply and demand. That's essentially the two sides. One wants to keep interest rates high, one wants to bring interest rates down, depending on the state of the economy. All right, so here's gold. Gold's still doing really well today. Here's the SPY. We could put like the dollar index, maybe Nvidia. Where did GameStop do today? Here's GameStop. GameStop's still sitting at 30. AMC still over 5s. Nvidia still very strong. Broke lifetime highs again at almost 127s. Right, exactly. A soft landing is you want to bring inflation down without causing a depression. Because if you keep interest rates high for too long, eventually spending dries up so much that people lose jobs, businesses shut down, people struggle. And so the point of a soft landing, if you hear that term a lot, soft landing, hard landing means you kept interest rates too high for too long and caused a recession, basically, hard landing. Soft landing means you brought interest rates up, but you didn't keep them up for so long and you didn't raise them so aggressively to where they caused a recession. Basically, raising rates without causing a recession is a soft landing. Raising rates and causing a recession is a hard landing, right? And so, yeah. And said no. Yeah, maybe. I would argue we need a depression instead of kicking the can down the road. Well, yeah, I mean, if we want, prices don't literally go down. I almost said literally with a CH, but literally prices don't go down, usually. The only way to make prices actually go down is a depression, Outside of that, the best we can do is slow them down. Even today, right? Today we had CPI inflation came out at 3.3%, which means prices are up 3.3% on the year. Fed wants 2%. If we get 2%, that's a great inflation rate. The whole point of all of this, though, the point that the light bulb in your head that should go off should tell you that if you're not investing your money, you're losing money to inflation over time. And so I know a lot of people are distrusting of the market. You can buy treasury bonds if you don't like the risk of the stock market or other, financial assets. You can buy treasury bonds. You can get certified deposits. There's a lot of guaranteed returns as well. Bonds right now will pay you 4% a year, 5% a year, 4.5%, 5%, depending on how long the maturity date is out. But yeah, there's guaranteed returns as well. You can invest and diversify into bonds, and it's a guaranteed return by the U.S. government. You can buy certified deposits, which is just banks will pay you a certain interest rate just to open up a bank account with them and leave your money there for X amount of time, right? It's called a certified deposit. Those are useful as well. Easier to deal with. I think there's a lot of good ways to do it. Historically, what do you see today's announcement react? Again, my theory today, and again, it's straight up just a theory. I really have no idea, right? So my guess today is that the Fed is going to. My guess is that they're getting pressure to. My guess is that they're getting pressure to cut rates, right? I think they're getting pressure to cut rates. I don't think they're going to cut rates. And so I think to compensate for, they have different groups wanting them to cut rates. I think because they're not going to cut rates, I think Powell is going to have a dovish tone, personally. I might be wrong, might be wildly wrong. Maybe he's super hawkish and bearish and markets tank. I don't know. My guess is that he's going to be dovish. But again, I might be straight up wrong. We'll see. Remember, not an investment professional, not liable if you lose. Understand CFTC 4.41. Hypothetical or simulated performance have limitations. Don't copy me. Don't sue me. I'm not an investment professional. I'm not liable if you lose. Chat. Yeah, I have no idea what you should do, Dennis. No idea, bro. bro's got a great voice. Never heard of him. Was cooking lunch, and the whole time I thought he was, yeah. I mean, I'm from South Louisiana. It's probably the accent you hear, you know. So, go Tigers, I guess. New to this, what effect does high interest rates have on markets? Will it be bearish? I mean, it's not either. It's not bullish or bearish. Hey guys, I always love to bet against all odds, so my bet today is that we're getting an emergency rate cut of 25 basis points, which will cause the markets to jump. Maybe. I mean, listen, I disagree. I don't think it's a good idea to do it. But I mean, we'll see. Again, good luck. Maybe. You know, maybe we get that. I don't know. I don't think so, but it's possible. So what you think they will cut rates this year or unlikely? I think they'll cut this year. I don't think they're going to cut today. I think they're going to cut. I think right now it's September is the guess. So, again, I think they're going to cut. I don't think they're going to cut right now. I'm going to put it in sub-only mode as well, chat. So y'all hit that subscribe button. Hit the notification bell. Help me break 150K subs. We're getting close. We're at 141 or something like that. So 9,000 subs left. We'll hit it sometime over the next couple months. Continue to help support the channel. We appreciate it. And, yeah. Again, we're going to stream the full press conference and everything. Yeah, I mean, the odds are for September, right? So the odds are likely for September, but again, anything could happen. You know, so right now most people expect September, but it could be later than that. Really, like people, here's one of the biggest mistakes people make in terms of Fed policy. Is that people hear, and I said this morning, but I'm going to say it again. People hear Powell, like say Powell 6 months ago said they were going to cut 3 times this year, right? I heard this morning. Things have changed. You know, that's super unlikely that we're going to cut 3 times this year. You know, so whatever he said 6 months ago is completely irrelevant to what's going on right now. You know, one thing that you'll hear Powell say a lot is that he's taken a data-dependent approach. Meaning Powell is only looking at data, you know, so Powell will change his outlook with different data releases that come out. Hey, thank you, Lag. I appreciate it, brother. Thanks so much, man. Gifted 10 beginner trading memberships. Hey, thanks, brother. I appreciate it. That's great. Thanks so much. Great donation, man. Thanks. I appreciate it. Looks like you're a Minecraft streamer. My son loves freaking Minecraft. But yeah, thanks so much, man. Appreciate it. Yeah, you'll be able to watch the entire stream right here. So you'll be able to watch the entire FOMC meeting right here like we always do. Yeah, so a couple people just got some free memberships. So hey, you can use beardless John emojis and everything right now, man. But yeah, thanks so much, dude. I appreciate it. Look at beardless John. We got my wife Carol. We got Rosie the German Shepherd. Okay. Why are you spamming, dude? Good day to you, sir. Wait, oh, sorry, Daphne. 300 seconds. Sorry, Daphne, I banned you for 300 seconds. All right, guys. Hey, we got 4 minutes. 4 minutes. If rate cuts, will it be bullish for crypto or bearish? It's hard for me to tell. Generally, Bitcoin follows the broad market short term. But I don't know. Number one, I'm going to tell you this. We're probably not cutting rates today. You know, we're almost certainly not cutting rates, right? That's the first step. Probably not cutting rates. We're almost certainly going to pause rates today. Now, I might be wrong. Again, anything could happen. Yeah, anything could happen. But, yeah. It's just super improbable that we're going to cut rates today. It's just not very likely. sorry, I'm exiting out of some stuff here. I hear my computer going loud here, so. All right, guys, we got 3 minutes left. I'm trying to exit out of stuff as fast as I can. All right, guys, 3 minutes. About 2.5 minutes left. We got about 3,000 people here. Yeah, Bitcoin's moving up. Again, the SPY is right in the middle. Nvidia is at 125.60s. There we go. All right. Hope the whole market drops 58% today. Well, it's not going to, but hey. Pause today and July 1st cut September. I think we're going to pause today. I think we're going to pause today and have a dovish tone during the press conference. That's my guess. Straight up guess. No freaking idea if it's right or not. Again, just a straight up guess. We'll see. Again, the Fed will cut rates if it feels like the economy needs saving. You know, it'll cut rates. It'll bring interest rates down, try to stimulate spending if we're at risk for things. The Fed will pause rates if they like the current economy. The Fed will raise rates if inflation's a problem, right? That's kind of the guide. Pause if things are okay. Raise if inflation's a risk. Cut if recession is a risk, right? That's the guide, okay? Still, we know what they're going to do essentially before they do it, right? So we know right now the Fed is almost certain to cut rates, or to pause rates. They're almost certain not to cut rates. You can look here and see all their decisions and all that good stuff. Again, just not very likely that they're going to cut rates. We got the press conference at 2:30. It's going to be huge. Stick around. Give me your last minute predictions. We got 1 minute left, chat. 1 minute. We got about 3,500 people live. Again, let me know what you guys think. Here's the last decisions. The new one will show up right here. If you want to know kind of how this works, the new one will show up right here. The minutes reports right here. And then we're going to stream the press conference live as we always do. 40 seconds, chat. 40 seconds. Yeah, I have no idea, Dennis. I don't know anything about that cryptocurrency, brother. No idea, man. All right, guys. You guys ready? 15 seconds. All right, here we go. Let's watch the market. There's Nvidia, gold, SPY, and here's the report right here. All right, there's the decision. Watch the SPY. Market is, I'm assuming we were pausing. Let me check. Okay, so the June meeting is out. Yeah, so they paused. The committee decided to maintain the target range for the federal funds rate at 5.25% to 5.5%. They paused rates. They didn't do anything. They kept them the same. As I told you guys, they would. They kept rates the same. They did not. Yeah, they did not cut rates. And again, rates held at 5.25% to 5.5%. I'm going to read you guys the paper they said. They said, quote, recent indicators suggest that economic activity has continued to expand at a solid pace. Job gains have remained strong and unemployment has remained low. Inflation has eased over the past year but remains elevated. In recent months, there's been modest further progress towards the committee's 2% inflation objective. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. They judge those risks to achieving its employment and inflation goals have moved towards better balance over the past year. The economic outlook is uncertain, and the committee remains highly attentive to inflation risks. In support of this, they decided to maintain the federal funds rate where it was. And considering any adjustments to the target range, the committee will carefully assess incoming data. Now, again, we got the FOMC press conference going live soon. Again, a pause, neutral report here, as we told you guys they would. My guess is that we're going to have a dovish Fed press conference. That's my guess. A dovish Fed. That's my guess. I might be wrong. Yeah, that's my guess. Dovish Fed. We'll see what they say. And, what do you guys think about this? Yeah, I mean, this wasn't dovish. This was neutral. Again, the Fed will pause rates if they're essentially content with the current economy and inflation. And so they're just keeping rates the same. Nvidia is spiking up, though, so that's good. We are seeing some rises and other things. Dovish means they want to keep... They want the economy to expand. I think the Fed is going to be... I think Jerome Powell is going to be dovish during the FOMC meeting. So I think Powell's going to be dovish during the FOMC meeting. That's my guess. Is that a dovish Powell, a dovish Fed? That's my guess. I think Powell's going to be dovish. I don't think they are going to say... Yeah, I don't think Powell is going to... Yeah, I think they're dovish. I think Powell is going to... I think they wanted them to cut rates today, and Powell didn't. And so in response to that, I think Powell is going to have a dovish tone during the press conference. Although, again, straight up guess. This is just a straight up guess. And yeah, let's get ready here, chat. Let's get ready. We got the FOMC meeting live, so be ready, chat. Powell speaks. Stick around. Again, I'm going to put the timer up. We got about 25 minutes until the speech happens. About 26 and a half minutes or so is what we'll give it. Powell speech is here. Market has been flat, choppy, basically a very small reaction to this report. Nvidia is still moving some, but again, you can kind of see how similar Nvidia is with gold. Gold is sitting on the left side here. Gold is at 2340s. Again, that's my guess. I think it makes logical sense. I think Powell is getting pressure to cut rates, but he doesn't want to cut them too early, and so he's going to pause rates and then speak dovishly to compensate for it. My guess in that regard, maybe the market moves up with the dovish talks by Powell. I might be wrong. You know, dovish talks from Powell would signal that they're not as worried about inflation, and that's good. But yeah, again, when we read this report, right, when reading this report, it says recent indicators suggest that economic activity has continued to expand at a solid pace. Job gains have been strong and unemployment has remained low. Inflation has eased but remains elevated. In recent months, there have been modest further progress towards the committee's 2% inflation objective. They want to achieve maximum employment and inflation at 2% over long run. They judge the risk to achieving its employment and inflation goals have moved toward better balance over the past year. So yeah, that's basically what they said. Again, the actual full press conference is going to be live here at 2:30. Put this back up. Yeah, again, this note is not going to be enough. You know, we got to wait. Like, here's the little bitty report they gave us here. It's not going to be enough. We got to wait. Like, an example of this is like, look, here's the report. You can also get a PDF file, but we still got time. Yeah, I'm looking at the monetary policy decisions. And again, stick around. We are going to be streaming the full entire Yeah, so again, the Fed has kept monetary policy largely unchanged. This is what AI says. I did use AI to break it down. Fed Reserve has decided to keep monetary policy unchanged. It will maintain the interest rate on reserves at 5.4%, and the federal funds rate target will remain between 5.25 and 5.5. It's going to continue with its overnight repurchase and reverse repurchase operations at specified rates. It has set caps on the reinvestment of principal payments from its holdings of Treasury and agency securities. The overall stance can be considered hawkish. It aims to maintain higher interest rates to possibly curb inflation or prevent an overheated economy rather than lowering rates to stimulate economic growth. So yeah, the Fed, and again, the reason they're describing this as hawkish, AI is because, all right, let me get my little drawing tool out. Okay, so the Federal Reserve, right? They've been raising rates, and they've been doing this in response to 2020's pandemic and inflation spikes that occurred from low interest rate periods in that point. So if we look at like the federal funds graph, I think there's a way for me to look at it on TOS as well, but. Right, so here's the federal funds rate decisions. Okay, and you can kind of see this here. You can kind of see this here the last 5 years since 2020. Again, you can kind of see the Fed stepped in. They lowered interest rates after 2020. They printed money. They lowered interest rates. They sent out stimulus checks. The consequences is inflation. And so the reason this is considered hawkish is because starting in 2022, they raised interest rates. This is them raising rates. And they've been pausing rates since mid-2023. They've been pausing rates since here. And so, you know, the reason they're calling this hawkish is because they raised rates a bunch and then they kept it the same, right? A dovish sign would be cutting rates back down, right? So them starting to lower rates would be a cut, or would be dovish. But we're not there yet. And again, I agree. We're not there yet. We shouldn't cut rates. It's too early. Too much pressure from real estate professionals to cut rates, and the economy can't really handle that, I don't think. Yeah, so again, Powell speaks at 2:30. We got the timer in the top left. Powell speaks at 2:30 in about 20 minutes. When the decision is what expected, all that matters is what Powell says. 100%. 100%, exactly. Again, my theory, maybe I'm wrong, could be wrong, is that Powell is going to have a more dovish tone than expected because he's been getting pressure to cut. And since he didn't cut, he's going to kind of, you know, lack of a better word, pander to them a little bit and be dovish. Maybe that changes in the next meeting. We'll see what happens. Dovish is good for markets. I would say a dovish tone is good for markets. I don't think cutting rates is good for markets. And I know that might seem contradictory, but I think a dovish tone is good for markets because I think he has to pad not cutting rates a little bit. He's got to basically say, hey, it's going to be okay. Look at all these dovish things, right? That's my guess, is that I don't want them to cut rates. I think that's a bad move, but I think he has to kind of pad it a little bit with dovish talks, essentially is what I'm saying. I think that's what he's going to do. That's what I would do if I was him. I would say, hey, guys, we're not going to cut rates, but look how good things are, and maybe we'll cut rates soon, you know, because you can't basically, even if that's not his plan, he basically can't say, yo, we're not going to cut rates at all this year, freaking deal with it. He's not going to do that. Instead, he's going to say, oh, well, you know, look at all these good things, but we're not cutting rates. And I think that's the right move. Where's crypto at? What did Bitcoin do to this? What did gold do? I haven't really looked at gold. Gold dipped a little bit. Markets are mostly flat from this report. And it's a neutral reading. Like, this is a neutral response. All right, guys. Bitcoin started to bounce, but dipped a little bit from this, as we expected. And all of this stuff is still up from CPI this morning. So we still had positive inflation data this morning, and so that's still a good thing. You are correct. Yeah, I mean, I think it makes sense, right? I think it's logical. Also, guys, if you haven't already, check out one of my sponsors. Apex Funded Account Program is one of my sponsors. If you want to day trade, I'm here to tell you, do not risk thousands of dollars in the beginning. Almost all day traders lose money. I don't care who you follow, what mentor you have, what course you take. Almost all day traders are going to lose money. You know, it's very difficult. You have to condition yourself through repetition to do it right. And most traders lose. Most day traders lose. And so do not risk thousands of dollars. Instead, test your skill with a funded account program in futures. In the futures market, you can trade the NASDAQ. You can trade the S&P, basically the SPY and Q price action. Patterns are very similar to large cap stocks. if I put up NVIDIA chart and then I look at the SPY, which is what the S&P tracks, they look very similar. But I can basically trade the SPY and futures in what's called the E-mini. It's the same price action. This is basically the same as this. You can see it here, right? I can day trade this middle one in futures, no PDT restrictions. Apex is one of the most legit funded programs in the world. They give you a demo and they test your skill with the demo account first. They have packages from 25K all the way to 300K. The 25K only costs about 40 bucks right now. I think if you use my link, you get it for about 40 bucks. And they're going to give you a demo. You know, I think you can get the 250K one right now for like 50 bucks. So they're going to give you a demo of 250K. If you can hit their profit target without hitting their max loss first and following their rules, it's a challenge. They fund you 250K with a 90% split. And so the split is similar to putting the money up yourself. You're keeping 90% if if you're able to take a withdrawal as long as you follow their rules. You're keeping 90% of what you make after you're funded, but the risk is way less. If you lose the 250K challenge, you're out 50 bucks. It's just a great way to learn how to day trade with limited risk, teach you how to trade under pressure, all that good stuff. If you want to check it out, here's my link right here. You can use my coupon code BT. Get you a max discount at all times. It'll get you 70% off right now. Plus, any resets $35 regardless of how much the account costs. And so if you have an account, you can reset it with BT coupon code for 35 bucks right now. Again, they're a sponsor. They pay me money. I'm biased because they pay me money. So if they paid you money, you'd be biased too. But I'm always honest about that. Check them out right here if you want to see what's up with them. All right. Understand CFTC 4.41 hypothetical or simulated performance have limitations. Understand, I do trade off stream. You're not going to see all my trades. I'm one of the worst traders of all time ever in the world. Anyways. All right, guys, we got 14 minutes, chat. 14 minutes. What color tie is Powell going to have on today? I don't know. Yeah. I mean, it just takes time to learn. Every day trader thinks they're has delusions of grandeur where they think they're going to just take a $5,000 account and run it into 100K and their family's going to be like, ooh, look at how smart John is. I'm here to tell you that's not happening. You're just going to lose 5K. And so don't do that. Instead, try a funded account program. You'll probably still lose, but you're going to lose less. And that's the point of it. Trading futures is the same as market. No, trading futures is commodity based, but you can trade the S&P and the NASDAQ on it. So you can trade index funds on it, and it's cheaper, Gold buy. What are we expecting for the Fed today? I don't know. Again, we'll see. Chat, we'll see. I think dovish tone might be wrong. Again, we didn't cut rates, which is what I told you guys. We're not going to cut rates. Love me some delusions of grandeur. Listen, every new trader does it. And the problem is that people invest so much money into these mentor gurus that it's really hard for them to look at it objectively. If I've spent 10K on a mentorship, even though he's selling the same course to 1,000 other people, if I spend 10K on it, it's going to be really hard for me to take a step back and say, hey, is this guy just feeding me a bunch of publicly available content? Can I find the same stuff online for free right now? You probably can, right? But that hurts. People want to justify their money that they're spending, and so they keep arguing for it, but yeah. I watch you because you're honest, and that's not easy. Yeah, we try. Yeah, I mean, most day traders lose. I try to be honest with people. Buy gold? Why? I mean, I like gold. I'm in gold. All right, guys, we got 17 minutes left. Yeah, you know how the internet goes. I could say, hey, guys, I'm not an investment professional. People ask me, hey, what should I do? I'm going to tell them I don't know. And people are going to say, see, John doesn't actually give you guys anything. I mean, I give you guys on-time market data, reactions, and break down what's going on in the economy. That's what I do. But, you know, then if I started giving out picks and saying, hey, guys, you know, I think this is going to happen. I think that's going to happen. They're going to say, oh, this guy doesn't know what he's talking about. Or, oh, this guy, his ego is too big. Top 3 biggest egos in the world right now. Nvidia at 126. It's been dragging the market up. Is Apple still up? Has Apple held these gains after the Fed decision? They have, and they're testing lifetime highs again. Apple lifetime highs are at 218.12 right here. Yeah, I feel you, Peter. I'm not mad at that, man. Yeah, I don't know. Yeah, honestly, my strategy that's worked really, really well, day trading. And again, I'm going to preface this with, can't guarantee it's going to work for you. Not an investment professional. Not liable if you lose. Do not copy me. I might be wildly wrong about everything I say. But the strategy I've been using is that typically ahead of big economic days, the market's sideways. The market's flat. The market's choppy. The market's boring. And so a lot of the time, like the day of the FOMC meeting, say this line right here is the opening bell, right? A lot of the time, the day of the FOMC meeting, we're going to get movement like this. You know, leading into the FOMC meeting, which might be at 2 p.m. Say this is 2 p.m. where we get like a blast up or a blast down or whatever it is, right? And so my strategy is very simple. It's what I'm up today on. Like I traded the same strategy today. My strategy is just waiting for days where we have that rectangular range and attacking sideways chop, shorting the top, buying the bottom, shorting the top, buying the bottom, you know, and just doing that all day. It's not going to work over and over again. But that works really well for my day trading. I've been doing it every major FOMC day, Fed minutes report, CPI day. You know, and it seems to work. I'm still testing it with small size. But again, we did that today, and we are up about 340 or 350 today in terms of my stats. The other strategy that I use for swing trading and investing is I just look for blue chip stocks to overreact to some catalyst, whatever the catalyst is. If I find a blue chip stock that I think is healthy, dropping 20%, 10% on earnings that are mixed, that aren't even terrible, but it's really extended on the downside, I'll start to kind of scale into those positions with small size and then just let time, you know, help me in those trades. Most of the time they're going to bounce back, fill the gap a little bit sometimes too. And so I can kind of buy really cheap blue chips when they're extended on the downside. They're not going to be every stock. And a lot of the time I'm looking at like PE ratios to see, you know, price to earnings, whether it's cheap or expensive, PE wise and stuff like that. And when you put all of it together, I've done this a lot and it's been pretty successful. I can't guarantee it's going to work for you. You know, this is just something that I've been doing with my own trades. I did it with Airbnb, nicely green. Did it with Apple, nicely green. Did it with Salesforce, very green. Did it with Home Depot, took a lot of profit off of that, still very green. Home Depot flew. Did it with Intel, slightly red on Intel now, but I did take profit in the green yesterday. Did it with Snapchat, Shopify, Roblox, Uber, Target, Disney. Been green on most of those. Powell speaks in 9 minutes. So yeah, Powell speaks in 9 minutes. Let's see what we got. Yeah, so Powell speaks in about 9 minutes. We're gonna get the stream up, and again, we're just sitting here waiting here, chat. We're just waiting for this live. Try to build this to where we kind of keep everything up. We put 2 charts up here, gold, the E-mini S&P futures contract, and yeah, we'll just wait this out. See if it makes it a little bit bigger. There we go. See what Powell says. We'll see how he reacts. Hawkish or dovish, chat? If you listen to a trading guru, yeah, I mean, I think most of the stuff people sell in courses is just publicly available content. It's just stuff that's already out there for free. Like, you can find most of that stuff in online for free somewhere. You don't need to pay thousands of dollars, and that's what tricks a lot of people. Man, people are looking for the easy road, and so a lot of times people just they you know, if you want something to be true, right, you're more likely to ignore the red flags behind it. And so if you want to believe that, you know, a lot of the times they pander to what people want, right? So if I want to believe it, say like if I'm struggling financially and I only got like a couple $1,000 and I want to believe that I can turn that couple $1,000 into $100K in a month day trading with some super secret system that nobody ever knows about, right? That's a pleasant thought, right? I also want to believe that I could win the lottery 5 days in a row, but it doesn't mean it's probable. And so, you know, what these people selling mentorships and courses do, and again, they hate me because I'm honest about it here. But what they do is they promise, they sell a dream. They promise the world. Most of the time, the stuff that's in those courses are publicly available stuff that you can find on the internet for free. Again, a lot of the time, the people that get tricked into buying it, it's so hard for them to look at it objectively, like truthfully, that they'll tell people, oh, it's the greatest course I've ever taken. This is the greatest thing. It might be terrible content, but again, they're so desperate to justify that expense in their head. They're sitting there saying, oh, it's the greatest freaking course in the world. You know, and again, that doesn't help them. You know, sometimes they look at them like celebrities. I think it's just easier to find content online. You know, I'm not saying you could Google and find most of these guys' courses available for free on the internet somewhere. And, you know, I would never, of course, like recommend you guys Google some of these guys' courses and find them available for free out there on the internet and not have to pay thousands of dollars for it. I would never tell you guys to do that. But with that said, do y'all think Powell's going to be hawkish or dovish today? Chat, do you guys think he's going to want to bring interest rates down in the future? Short term, do you think he's going to bring interest rates down in July, in September? I think right now the probabilities are in September. And so, what's the issue with PDT? PDT states you only can day trade 3 times per rolling 5-day period if you got a margin account with less than 25K in it. It's a ridiculous rule. Hey, was Tiny here? Did Tiny get memberships? That's cool. Yeah. For us Scandinavians, it's weird to buy education. I mean, look, I'm a capitalist, okay? But I also believe that education should be free. You know, like, let's follow the standard of the rest of the world. Big money has gotten way too involved in education. It makes it crazy expensive. You know, and it's worse because people aren't getting good majors anyway. They're getting, like, a bachelor's in communications. You know, a degree is better than no degree. But is locking yourself into $100,000 in debt worth it? I don't think so. You know, personally, but again, I'm biased, I guess. But yeah, I'm okay with free college. I think college should be free. because at its current state, it does, like, it is hard for some people to go who can't afford it, you know. And I think we should level that playing field. Just let whoever wants to buy it, you know, whoever wants to go to college go. But again, I'm a capitalist, so my capitalists, don't get mad. I know some of you guys are like, how dare he say that? I know, I can feel it. But yeah. Anyways, guys, we got 2.5 minutes here. Chat, 2.5 minutes. Just because you want to go to collage, I paint a nice collage. We got 2 minutes here, chat. 2 minutes. All right, chat. 2 minutes. 2 minutes. Let me see if I always like go into their website a little bit more. Can y'all hear the music real quick? Hold on, chat. Let me do a sound check real quick. Do we? Can y'all hear the music? Yeah, no, I'm just kind of. I gotta do it, Yoko. I'm sorry. You know, don't break up the Beatles, okay? All right. You guys ready? We're waiting here. We got 2 minutes. Here's gold. All right, guys, you guys ready? Oh, they got bad hold music on. All right, guys. Here we go. We got 45 seconds left. Still waiting here. Oh, yeah. Can y'all hear my music? Did we answer that? Here, I'm going to stop this and then restart it just so I know you guys can hear my music. There we go. Make sure. Yeah. Okay, cool. Let me turn the music off now. Still waiting here, chat. All right. All right, here we go. Oh. All right, guys. There we go. All right, we are live. Sound is up all the way. All right, guys, here we go. My timer's going off late. That's all right. I don't know. If my tax money is getting spent on anything, I guess education's the justifiable one. You know, let's be honest. There's a lot of other less justifiable ways. All right, here comes Powell. What color is this tie? It's purple. Man, he likes purple ties. All right, sound check. Let me know if you can hear him.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SCP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December, really, and we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and then hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Nick Tamarosa of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings, like the one that we saw this morning, make a September interest rate cut possible?
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the dot, their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I don't really, I can't really distinguish between two of these. They're so close for me. These are very close calls. But we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around one or two. So I think I would look at all. I look at all of them as plausible, but I'd look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly, more good inflation readings will help with that. I'm not going to be specific about how many because, really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that, and we see today's report as progress and as building confidence. But we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that, and some people do, some people don't. Most people don't. And I'm not going to get into the specifics, but you have the ability to do that. So that what's in the SEP actually does reflect the data that we got today, to the extent you can, reflect it in one day. I think you will see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its, kind of first level translation to PCE we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
John Allen.
Hi, Chair Powell, Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit, it's softened a bit, and you know, that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still, they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand, and that's why it always makes sense to look at a series, you know, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, I mean, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, you know, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago, or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. Can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year. And as I mentioned earlier in the, what did we take away from this? We had really, really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter. And what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year take place next year. You know, there are fewer rate cuts in the median this year, but there's one more next year. So if you look at year-end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. You know, the economy has, you know, repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina. Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. You know, how should we interpret what that means about how the committee views its current policy setting?
So 2 things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, But honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were very low by recent history measures. Now we can't really know that. That's an interesting dispute and discussion to have now. But ultimately, we think that things like the neutral rate are driven by longer run, slow-moving forces, and there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Well, thanks, Chair Powell. Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about, looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal. And then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking, and that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that, though. We're look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market, and your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that, you know, since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but, you know, no one has that as their base case. So no one on the committee does. But so that's you know, that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation, with growth at a good level, and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and you know, that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market, while we're continuing to make progress on inflation. So I mean, we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
On housing, you know, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. I mean, ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, you know, low mortgages. In terms of banks, the banking system has been, you know, solid, strong, well-capitalized, lending. You know, we've seen good performance by the banks. We had the turmoil early last year, but, you know, banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, you know, seems to be in good shape.
Chris.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, you know, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, you know, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, you know, and I think you can see it in various places. You know, in some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and, you know, we've taken some signal from that, but you know, and of course, housing services, you're continuing to see high readings there. To some extent, that's you know, catch-up inflation from earlier pressures. But I mean, overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, you know, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, you know, cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy, what you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years, and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. You know, really the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully. And we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We you always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month and we said, okay, the signal we're taking is that we think it's going to take longer to get confidence that inflation is moving sustainably down 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction, but one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Jolene. Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
I don't think anyone knows, has a definitive answer why people are not as happy about the economy as they might be. And we don't tell people how they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of a long period of high inflation. It is people who, lower income people who are at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year, and I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Claire.
Claire Jones, Financial Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, particularly the second half of last year, and we continue to see still strong growth or solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that, and that's not what happened. Instead, the U.S. is anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about. Your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there are renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning of when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increases in market rents that has to get worked off, and that may take several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It just is going to happen more slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does. And it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward.
Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home, but households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as it's spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still It's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But you're right, though. We do see the same thing other people see, which is increasing financial pressures on more lower income people. And the best thing we can do is to foster a very strong jobs economy, which we think we have done, ultimately to get inflation under control, because those people experience inflation, very directly, very painfully. And once we get inflation under control, rates can come down, which will also improve things.
Victoria.
Hi, Victoria Guida with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken? When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to move to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So. And also the fact that we look at all of the whole situation. So, a decision to begin to, loosen policy could have several reasons associated with it at a given time. But I would just, we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too. So something like negative payroll numbers would be.
I'm not going to. I can think of things many things would make it on that list, but I don't think I'll butter them here.
Thank you, Chair Powell. Simon Urbanovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that it looks like May will be quite good for PC as it was for CPI? Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
I don't actually have that kind of mechanical thing in my thinking. I get that, as many good ones as we had bad ones, but no, it's not like that. It's going to be the totality of the data. The labor market data, the growth data, in terms of inflation, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things because that points to dates, and I just don't think we're not at a point of being able to do that.
Kosuke.
Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that the market should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't. Actually, it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, and for our economy, what we're trying to foster is maximum employment and price stability, And we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE, or at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once? You're well above neutral, to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation.
You know, so we're well aware of the two-sided risks here. Let me just say, we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is, you know, an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there. And you know, we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low. So we have the ability now to approach this question carefully, and that's what we're doing.
And just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Evan.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing. And all the other details, we don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't. There isn't any one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example, and we don't target wages. We target aggregate prices and overall employment. So,
But if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you look at we'll be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
Okay, guys, so that was Powell in the FOMC meeting. Again, look, I agree with Powell. Everything that you heard me say here, Powell basically said. And I'm not always agreeing with Powell, just to clarify. I just think, look, I'm telling you, real estate agents, lenders, mortgage brokers, they want rates to go down. They want rates to go down because a lot of them can't handle business without lower rates. Their customers dried up. They're desperate for rates to go down. That bias causes them to say, hey, let's cut rates. Hey, let's cut rates. The bigger picture here is that inflation has gone up a crazy amount in 5 years. We can see this reflected in everything. And these high prices have been reflected in everything. That's the number one reason people are really struggling. You don't hear people say, oh, it's hard to find jobs. You hear people say, hey, prices are freaking crazy, because they are. And so I agree with Powell. This is something that I've said way before this FOMC meeting. I agree with Powell. We can't just pander to lenders and cut rates. It's just not a reasonable thing. Not if the economy's thriving, we shouldn't, especially in the environment that we've had over the last 5 years. It just makes no sense. It just makes no sense. Instead, we need to keep interest rates high. We need to we need to discourage spending and combat inflation, make sure we really get a handle on inflation before anything else. Yeah, and that's basically what Powell said. I still think he was kind of dovish, to be honest. I do think he was a little dovish. I don't think it was super hawkish. I think people just kept asking him about it. So he kept answering basically the same thing. We're not going to give you a specific date. We're not going to give you a specific date. We're not going to essentially just, cut interest rates one time and then potentially have to raise them back up. I just don't think that makes any sense. It doesn't make sense to me. I think it's the smart move to keep interest rates where they are. The economy's doing okay. Labor market's strong. Inflation's getting a little bit better. Let's keep things the same. I don't think it makes any sense trying to change the current environment of interest rates currently. And so I agree in that regard. And I think that makes sense. I think expecting him to cut rates just for one specific segment of people who aren't thriving like they want to thrive is silly, selfish, unnecessary. And I'm a real estate agent myself, right? So again, I have every bias to say, yeah, let's cut rates. Let's bring these interest rates down. My customers would skyrocket. But it's just not a reasonable thing. Inflation's a problem. It's been a problem for 5 years. We can't deal with higher prices again. I just don't think it's reasonable. Anyways, guys, if you haven't already, check out some of my sponsors. One of my sponsors is Apex funded account programs. Apex is a great way to learn how to day trade. A great way. Most day traders lose. If you put up 10K of your own money, you're probably about to lose 10K. Okay, most day traders lose money. And with that understanding, do not risk thousands of dollars of your own money trying to day trade, especially in the beginning. Most day traders lose. Instead, try these challenges. They give you a demo and they test you. If you pass the test, they fund you. If you don't pass the test, you only lose what you pay for the package, which the base one's like $40 right now. You can get the 250K challenge for like $50 right now. It's still pretty cheap. You get, which is 70% off. Great way to learn how to day trade. For this 250K challenge, they're going to give you a 250K demo account, paper account. If you can hit 15K in profit without losing 6,500 first, they fund you 250K with, as long as you follow their rules, with a 90% split, and they pay out millions. Over almost 200 million is what they paid out to their traders, over 150 million. Great way to learn day trading. If you lose, you're out $50 a month. It's not the end of the world. It's a great way to test your skill, have a middle ground of pressure, but not the full extent. And in the futures market, there's no PDT rule. You can day trade short, very similar to day trading stocks. You can't trade individual stocks directly, but you can trade futures, which you can trade the S&P 500, the NASDAQ, basically what the SPY and Q tracks. You can trade that on Apex. Learn how to day trade. Patterns are very similar to large cap stocks. You can check out the link right there. Remember, they are a sponsor. I'm biased. They pay me money. I'm biased because they pay me money. I do trade off stream. You're not going to see all my trades. I'm not even claiming to be a good trader. Check them out. Understand CFTC 4.41 hypothetical or simulated performance have limitations, all that good stuff. Also, guys, my other sponsor here, and we are going to do a crypto show, so stick around. We are going to be doing a crypto show today, so don't go anywhere. We're going to do a very quick crypto show. I got to run in a second. I'm kind of running late as it is, but it's all good. We'll do a really, really quick crypto show. My other sponsor, a company called Chart Prime, trading view service. You can use in stocks, crypto, forex, futures. I use these a lot with funded account programs. If you do check out Apex, again, use coupon code BT. Will get you the max discount. The max discount, BT, will get you the max discount. Always use coupon code BT. It'll get you the max discount regardless of what kind of sale they got on right now, what kind of, regardless of what they have, BT will get you the max discount that they offer. With that said, though, again, check out Chart Prime. Powerful. Again, you can use this with anything with the symbol. Check out this strong signal right here and look at the days of green action. Days of green action. This one looks like it followed through a little bit. This one probably didn't work. But this one looks like it, this one looks like it worked. This one looks like it didn't work. This one worked. Look at this rip down. Look at this strong signal showing up way back here and then a huge bounce. This sell signal didn't work. This strong signal worked. But again, test it out yourself. Like, look, here's the SPY. We can look at the SPY. You can use it with anything with a symbol on TradingView, and there's so much stuff that they offer. What I would advise you to do with these is, like, there are going to be periods where it's working really, really well, and there's going to be some times where it's not working. If you can identify the periods where it's working well, like, look, sell signal, half a day of red action, buy signal, half a day of green action, sell signal, half a day of red action, buy signal, nice bounce. This one worked, this one worked, this one worked. Looks like it worked at least. This one worked. Some of these didn't work. But again, you can identify these periods where they're working most of the time. Like, look, sell signal, anything with symbol. I can put up Tesla right here, and it works for the most part. And so again, it's a great way to identify some patterns here and try to find some edge in markets. Again, it's not always going to work. You want to back test with them first. But look at the strong signals here. Like, look. Strong signal here, boom. Buy signal, bounce. Sell signal, drop. Buy signal, bounce. This one didn't work. Sell signal, drop. So again, on Tesla, like 5 out of the last 6 work, so it looks like. So again, check them out. They're a sponsor. They pay me money. I'm biased because they pay me money. And I'm always trying to be honest, but it's like $40 a month. One good trade could help pay for it. Here's the link. Check it out. Also, guys, again, we're going to be doing a crypto show right now. We're going to be pivoting right to our crypto show. So don't go anywhere. Stick around. And yeah, again, that's like my 3rd plug all stream, so we're not doing too much plugs here. That's like our 3rd plug in 3 hours. Reasonable amount of plugs, right? I agree. Anyways, hey, I love you all. Remember, chat. Tomorrow, PPI inflation data, a big inflation report, very influential over markets. It's the other side of the CPI report. Yeah, y'all be safe. Good luck. Y'all be safe. And again, don't go anywhere. As soon as we close this stream, it should bring you to our crypto show. So as soon as we close this stream, it should immediately bring you to the crypto show. You shouldn't have to go anywhere. If it doesn't, for whatever reason, bring you to the crypto show. Let me make sure you got this link. If it doesn't bring you to the crypto show, let me pull this up. If it doesn't bring you to the crypto show, go to this link right here. Again, I gotta go. I'm really running late for something else I gotta do, but that's all right. Yeah, if it doesn't bring you to there, here's the link. But again, it should bring you directly there as soon as we close.